Why is Ethereum performing so poorly against Bitcoin while the crypto market soars to new heights? The trend might be more permanent than you think. Our guest James Check, lead on-chain analyst at Glassnode, brings deep technical insights into why Ethereum's structural problems run deeper than most realize. In today's discussion, we'll examine three central points: how the merge to proof of stake eliminated Ethereum's key advantage, why being too decentralized is actually hurting its primary use case, and how the Ether token could become worthless even if the network remains valuable. Before we continue, if you enjoy these breakdowns, hit the like and subscribe button for more TFTC content. Full episode linked below. By the end of this video, you'll understand why many institutional investors are starting to view Ether as fundamentally overvalued. Let's start with James explaining how Ethereum's shift to proof of stake removed its main differentiator from other chains.
Picture take is Ethereum is actually too decentralized. And that's going to be contrary to what a lot of Bitcoiners say, but I think it's too decentralized because they have, credit to them, gone to a whole lot of angle. It's still more centralized than Bitcoin, but they've done a lot of work to be more decentralized than the Trons and the Solanas and all this stuff. However, what if the main thing that your protocol does is move stablecoins around, which can be frozen? Really, the weakest link in your chain is Tether and Circle. That's kind of it. So they've gone down this path of like building all these like decentralized cannons, and they've forgotten that they're securing something which can be stolen by the issuer. So at the end of the day, if they freeze stablecoins, the whole thing falls apart. DeFi goes to zero because that's what people borrow. So they've kind of over-designed the machine. And they also went after the ultrasound money meme, which there was a war they were never going to win. And then once they flipped to proof of stake, that was really the last thing they had that was an edge. And if you go back, I mean, in fact, I've checked. The Ethereum.org website has been since updated, but the two listed reasons for the merge, and this video was made a month before the merge, the two listed reasons were to enable sharding, which is scaling. That got scrapped very soon after the merge, and they already had layer 2s and roll-ups and all that stuff going. So technically speaking, you kind of had already made the roll-up centric roadmap decision. So you didn't really need sharding in the first place. And the second one was to be environmentally friendly. And it's like, guys, proof of work is the most environmentally friendly consensus mechanism. It's the only thing you have that is different to Solana, that is different to Tron. They're all proof of stake. And by the way, just if they stayed proof of work, I don't actually think the result would have been any different, but it was the only competitive advantages they had. It's the only differentiator.
James Check provides a compelling breakdown of Ethereum's first major structural flaw, the loss of its key differentiator through the merge to proof of stake. He explains that Ethereum has actually become too decentralized for its own good, which might sound counterintuitive at first. Think about it like this. Ethereum has spent years building this incredibly complex, decentralized system, but the main thing people use it for is moving stablecoins around. These stablecoins like USDT and USDC can be frozen by their issuers at any time, which means no matter how decentralized Ethereum's network is, it's still at the mercy of these centralized stablecoin issuers. It's like building a super high-tech vault to store IOUs that someone else controls. The security of the vault becomes almost irrelevant. What's particularly revealing is how the two main justifications for Ethereum's switch from proof of work to proof of stake completely fell apart. First, they claimed it would help with scaling through sharding, but they abandoned that plan shortly after the merge. Second, their environmental argument against proof of work proved misguided, as proof of work is actually what makes Bitcoin's security model so robust. This decision effectively eliminated the one thing that made Ethereum unique among smart contract platforms. As we'll see in our final clip, this loss of differentiation has serious implications for Ether's valuation, but first, let's examine how Ethereum's role in the market has fundamentally changed.
Murad's done a good job, I think, of framing this up, but this is my take on it. If you go and look at the 2017 cycle, there weren't really no stablecoins. I think Tether existed, but not at any size. BTC was the pair. You bought Bitcoin, you sent it to Binance or Coinbase or whatever, and you traded shitcoins. So BTC was the thing you had to buy. It was the casino chip to go and bet on other stuff. Now, Bitcoin being special has left that realm where it actually doesn't need that demand anymore. It doesn't need to be the quote pair for the casino to achieve its value proposition. In the 2021-22 cycle, that was Ethereum. You had to buy ETH, the casino chip, to go and play in the DeFi yield farm. You get your 55,000% APY, which rugged you the next day. You needed to buy the casino chip and hold it to do stuff. Whenever an opportunity came up, you can't send your money to Binance, buy the ETH, send it to your wallet, and then go and do the thing because the thing's already pumped. You needed to have the ETH in your wallet.
The evolution James describes here perfectly illustrates our second point. Ethereum is too decentralized for what it's actually being used for. He walks us through how the cryptocurrency trading landscape has transformed completely. Back in 2017, Bitcoin was the necessary gateway to the crypto world. You needed it to trade any cryptocurrency. But that's changed dramatically. Bitcoin has evolved beyond being just a trading pair and has established itself as a serious monetary asset. Sup freaks, this rip of TFTC was brought to you by our good friends at BitKey. BitKey makes Bitcoin easy to use and hard to lose. It's the easiest 0 to 1 step, your first step to self-custody. If you have friends and family on the exchanges who haven't moved it off, tell them to pick up a BitKey. Go to bitkey.world, use the key TFTC20 at checkout for 20% off your order. That's bitkey.world, code TFTC20. Meanwhile, Ethereum became the new gateway for people wanting to participate in various crypto schemes, particularly in decentralized finance or DeFi. People needed to buy and hold Ether just to participate in these yield farming programs that promised astronomical returns. This created artificial demand for Ether. People weren't buying it because they believed in its long-term value. They were buying it because they had to in order to chase returns elsewhere. This is fundamentally different from Bitcoin, where people typically buy and hold it as a long-term store of value. What James is revealing here is that Ethereum's value proposition was largely built on this temporary role as a casino chip, which isn't sustainable in the long run. We're already seeing this play out as more efficient platforms like Solana start taking market share in the trading and DeFi space. In our final and most revealing clip, James explains why this could lead to a dramatic devaluation of Ether, even while the Ethereum network itself remains useful.
But you don't want to see value destroyed in the world. But even if you go to the ETH Maxi websites, the PE ratio, at least to their calculation, if you look, and this is the thing, institutional investors, they come in, be careful what you wish for, one of my friends told me the other day, because when you actually value the tokens or ETH or anything on any typical valuation mechanism, you're not going to like the result, because it's like the PE ratio is 780 or 675 or something like that. If you take it down to a more sensible PE of 20 or 21, it's $100 ETH price. That's just, it's just that, and like 20 is like on the upper bound of equity. So be careful what you wish for, because there's a large monetary premium, so to speak, gap between the current valuation and where it probably wants to go. Now, this is all going to happen to Solana as well, but I think the Trump meme coin is, I'm still kind of processing what happened there and what the implications are. But my big picture take is, if you had done, wind back the clock 12 months, 24 months, there's no question that if Trump was going to launch a meme coin, I think everyone would agree it would have been on Ethereum. There's no question. It happened on Solana, right? So the Ethereums have now recognized, and by the way, the amount of trade volume, I think credit to Solana, by the way, the amount of trade volume and load that thing took on that day is unbelievable. From just a technological standpoint, you got to give it credit. That was quite impressive. There's no chance any Ethereum, L2, none of that system could handle what happened on that Trump meme coin.
This final point from James delivers the most crucial insight about Ethereum's fundamental problem, the disconnect between network utility and token value. He introduces a perspective that many cryptocurrency enthusiasts often overlook: traditional valuation metrics. When you analyze Ethereum through the lens of price-to-earnings ratio, PE ratio, which is how we typically value traditional companies, the numbers are staggering. A PE ratio of 700 or more is astronomically high. For context, even the most aggressive growth tech companies usually trade at PE ratios between 20 and 50. What James is revealing is that if you were to value Ethereum based on the actual revenue it generates relative to its market price, using reasonable PE ratios similar to traditional markets, the price of Ether would need to drop to around $100. This mathematical reality directly supports our third thesis point, that the Ethereum network can remain valuable for certain applications, while the Ether token itself becomes nearly worthless. Unlike Bitcoin, which has established itself as a scarce digital asset with a clear value proposition as a store of value, Ethereum's current price relies heavily on what James calls a monetary premium, essentially people believing it will be worth more in the future without fundamental reasons to support that belief. The challenge for Ethereum is that as more institutional investors enter the crypto space, they're going to look at these fundamental metrics, and the numbers simply don't add up. James's analysis shows that while blockchain technology might be revolutionary, the tokens built on top of these networks still need to generate real value to justify their prices. The combination of losing its key differentiator through the merge, being overbuilt for its primary use case, and lacking a sustainable value capture mechanism paints a troubling picture for Ether's long-term value proposition. Will Ethereum survive the rise of Layer 1 competitors? Let me know in the comments. I read every single one, and if you found this analysis of Ethereum's structural problems interesting, you'll want to watch our breakdown of Bitcoin's political stability through market chaos. Click the video on your screen now. Don't forget to like and subscribe for more daily content. Thanks for watching. Stay humble. Stack sats.